What's going on, real estate investors? My name is Hayden Crabtree. I'm the author of these books, and today's deal topics, we're gonna be looking at apartments or multifamily. All right, so as you can see here on my screen, I just went on LoopNet.com. If you're ever looking for commercial real estate, you can come on LoopNet. You can also come on Crexy, and this is where they list commercial real estate. So what I'm looking here is a 6-unit apartment building in Atlanta, Georgia, and it says they're selling it for a 6% cap rate. They're asking $1.299 million, $1.3 million, or $216,500 a unit. So we're just gonna read through this together. This is 6 townhouses, as we can see here. Units are 2 bed, 1.5 bath, 100% occupancy, meaning it's completely full right now. Property was completely rebuilt on, she meant to say in, 2017, 2019, 2 units built from scratch, brand new electricity, new plumbing, new interior, new roof, stainless steel appliances. All units are fully electric and have dishwashers and washer dryer connection. Excellent prime location in the north side of town. Cool. So sounds like it's a great location. Sounds like these properties have had a lot of work put into them. I'll just quickly kind of scroll through the pictures to see what kind of quality we're looking at. Looks pretty good. That's all the pictures. Sweet. So I can come down here and get some property facts, which is like the price per unit, again, the cap rate, number of units, lot size, so on and so forth. The property was built in 1963 and it was renovated in 2018. Here's a map of where it's located. This is my hometown of Atlanta, which I love. And here's some other details. So the total assessed value is $848,000. This is for property taxes. We'll come back to that in a minute, okay? And let's see, does it have a county here? My guess is it's in DeKalb County, Atlanta, just because I live here, okay? So now, guys, we have these details. If we want to get more financial details, we're going to click on this. The OM here, right? You see I clicked on this thing, OM, and I could also get more details, but because this is probably private and I'd have to log in and there's can't share on video type of stuff, I'm not going to do that. We have enough information from here. I'm going to show you guys. OM stands for offering memorandum. OM offering memorandum, which is essentially like a pitch deck, right? So I want to see the pitch deck here. It pulls up in this other tab. And again, it just kind of comes through, tells me about the property, which is great. This is great. This is great. This is awesome. No shower head there. This is awesome. Let's see. What I'm really looking for here is the pro forma and the 2021 T12. T12 stands for trailing 12 months. That's important. What we're looking at here is called a profit and loss statement. And again, if you've read Skip the Flip 1, you know that commercial real estate is based off of a cap rate, which is based off of NOI. So as we can see here, in 2021, she doesn't really specify here. We're shooting this video on June 1st of 2022. So really a T12 would be from May of 2021 to May of 2022, or AKA the last 12 months of that's happening. That's a true T12, but you could say, you know, what is 2021 P&L? So the way she has it labeled here of 2021 T12 doesn't make much sense given when we're looking at it. It may have made sense if she put this out in January. But anyways, we don't specifically know if this is an actual T12 or if it's just a 2021 P&L. Either way, it'll be fine. And then on the left side here, they have a pro forma, which is like, hey, here's what this property can do, right? I forget exactly what the Latin definition of pro forma, but it's essentially projecting into the future of what should happen. And that's what we're gonna build. We're gonna build our own pro forma here. But as we can see, we've got 6 units that are renting for $1,210 a month, although they think that market rent is $1,450 a month, but it's currently renting at $1,210. So we're going to take all this information and we're going to use it to analyze how good of an investment this is. We're going to do that with a real estate calculator, essentially. I built what I think is the world's best real estate calculator. It's called My Property Stats. In addition, we're kind of a dashboard if you already own investments. But if you're just trying to buy investments, that's what we're going to be looking at today. This is what I think is the world's best deal calculator. If you want to use this, it's normally just $99 a year for unlimited deals, and it does some really cool stuff. But if you want access to this, if you want to follow along with me, I will give you your first year absolutely free, and I will put that code in the description below along with the link. Just look for the mypropertystats.com. Super easy to sign up. I'll give you your first year free, then it's $99 after that, just because I love you guys, okay? So let's go through and do this. So we're just going to call this the Atlanta 6 unit, and we can plug in the address here. It's 2451 Peachwood Circle, right? And this is in Atlanta and Georgia, and that's fine. It's property type. This is a multifamily. It's got 6 units. Let's see how many square feet this thing is. 6 units times 1210 would be 6 times 1210 comes out to 7260 square feet. 7260, and they're asking $1.299 million for this deal, and this is going to be valued on a cap rate, and we're going to plug in a 6 cap, although I think that might be a little low on this deal. So we got some general information in. Now let's go look at our loan. Let's say we're going to use a 75% loan to value. It's going to be a 5% interest rate on a fixed rate schedule, 360 months. That's good for apartments. Let's say that we pay a lender a half a point, which means our payment's going to come out to $5,229 a month. Okay, and I want to check that yes, this loan will be used to purchase this property. It doesn't say we need any improvements, so we're good there. Closing costs, I'm going to do probably 3% here, which would put me around $35,000 is what I'm gonna put in for closing cost on this deal. Working capital, I'm gonna do 2 months of all expenses. I made another video, if you guys wanna check it out, I'll link it right here, talking about the 3 biggest rookie mistakes, and operating capital is one of those. And this will calculate how much operating capital you need, and we'll come back to this when I start plugging in some other stuff. So here is the summary, right? Is the purchase is $1.299 million, the closing cost of $35,000. I don't have any, let's see, this will actually increase as we go forward. I'll also have $10,000 of needed working capital. That's going to creep up a little bit. But here's how I'm going to pay for this. The total funds needed is the $1.349 million. I'm going to get debt of $974,000, which means I'm going to need to bring $375,000 to the table to close this deal. That is my investment amount in this deal, okay? So let's go look at the income. Apparently, they're all just the 2-bed, 1-bath, right? It says 2-bed, 2.5-bath, but I believe that it says 2-bed, 1.5-bath. So they got a little contradicting information there. I'm gonna be more likely to think that it's a 215, right? In square feet, I think it said 1210. Yep. And let's see, they got 6 units. Their current rent here, which I'm just getting off their OM, is 1210. Look, you can analyze deals absolutely free. Like, this isn't going to cost you anything to do to get the reps in to understand if this is a good deal or not. They say market rent is $14.50. I'll play along right now, okay? And then rent increases of 2% a year. We've really seen like 25% a year here in Atlanta. I don't think that'll continue forever. So I'm going to use 2% a year. And then that gives me a monthly potential gross rent of $8,700 here. But again, they're not collecting $8,700. Right now, they're collecting $7,260. So what do I have to tell my property stats? Is this property stabilized? No, it is not stabilized. It is renting for below market rates, which means that it is not stabilized. So we're still going to come in and say this property is going to run at a 95% physical occupancy, which is each unit being vacant about 3 weeks out of the year, which is probably about right in a high demand area. And then a concession rate. To figure out what my concession rate is, I'm just going to take the 1210 divided by the 1450, and that gives me an 83.44%. That's what as a percentage of market rent am I actually renting at, right? So in order to calculate my concession rate, it's going to be 1 minus 0.8344. That's going to give me a 16.56 concession rate. So just to explain a little bit, let's read this. We have a potential gross rent of $104,400. Again, you're going to have unit turnover. So I know it's 100% occupied right now. It's not going to stay that way forever. So again, 3 weeks out of the year are going to be vacant. That means we're going to lose $5,220 just of lost rent from vacancy, which is normal and standard. And then a concession rate, right? So it can go up to $1,450, but it's not currently. So we have to allocate what kind of income are we getting here, now, and today. So we will lose over the next 12 months, $16,424 to concession loss. That's just saying the money below market rent, that's how much we're going to lose. And then we should actually collect $82,775, excuse me, right? So if we go look and compare that number with what they actually did either in 2021 or T12, right? They did $73,000. So we're even giving them a bump on top of that. We're saying we're going to collect $9,000 more than you. And that's just how the numbers would work out here, right? And so if I don't enter in a year 2, that pretty much assumes that I'm gonna go to market rate by year 2, and the concession loss is gonna go all the way to 0. I don't necessarily think that's gonna happen. So what I'm gonna do is I'm gonna do, again, a physical occupancy rate of 95%, and I'm gonna say I'm gonna cut these concessions in half, right? I'm gonna work some of the units up towards market rate as they turn over. I might raise the rents on some tenants, to try and get them closer. But I don't think I'm going to get rid of completely all the concessions next year, mainly because if I buy it, some tenants might have leases that run into the future where I literally can't raise their rents. I can't kick them out. I can't move them closer. Sometimes they sign 12-month, 18-month, 24-month leases where they're locked in and you can't raise the rates. So that's why I'm going to do that. So that put me next year at collecting $93,000. And then because I'm not going to enter in year 3, it will mean I have no concessions. Okay? Awesome. So now that we've got our income dialed in, and by the way, if you have any questions, drop a comment below. Super happy to help out. Next up, we're going to go and we're going to do our property taxes, okay? So as we can see down here inside of their expenses, they don't really have much expenses. They have repairs and maintenance, they have management fee, water and sewer, real estate taxes, and insurance. Okay, so they have real estate taxes at $15,430. Well, here's the deal, guys. Your real estate taxes are paid based off of how much the property is valued at. Now, if we come back here on the LoopNet, it shows that the property is assessed at $848,200. Well, guess what? We're paying almost 50% more than that. So that means our property taxes are going to go up. Okay, so what I'm going to do here to confirm is I'm going to come and I'm going to look up pay DeKalb County property taxes online. Now what that's going to do is it's going to bring me here. I'm going to pay my property taxes. I'm going to look up this address. So again, this address is 2451 Peachwood. And I'm just going to search for this. Here we go, 2451 Peachwood Circle. Let's take a look. I'm going to click here. And it's going to allow me to get the tax bill details. Voila. So I come here and I'm going to look at the tax bill. So the total appraisal, $848,200. So LoopNet was correct about that. So now I'm going to come into my current assessed value and I'm going to put that in, $848,200. Okay, now what I'm going to do is I'm going to look up what are the current property taxes. The current property taxes are $15,300, which again, they told us they were $15,430, so they're off $130, not bad. But watch what's going to happen. I'm going to calculate right here inside this calculator my new property tax bill. So again, the amount is $15,300, $15,300. And boom, my new taxes after I buy it for $1.33 million will be $23,431. They don't tell you that in the pro forma numbers, do they? Because whenever you buy and sell a property in disclosure states, which is all states except for 4 of them, Utah, Texas, and I forget the other 2, your property taxes go up to what you just bought it for. There's no arguing it, right? So here's my new property taxes, and that's gonna plug in down here for me automatically, okay? Now, let's go through and let's look at, I'm gonna get rid of these, and let's go through and look at the other expenses. So they have management fee. It says currently they're paying $5,800, they're gonna pay $7,300. Well, I'm not gonna look at either of those. I'm gonna use a property management fee of, let's say, 8%, okay? Now, 8% gets me $6,620 a year. Also, because it's in my property stats, as your income changes over years, your expenses will change over years, the ones that are tied to revenue, like property management fee, okay? Next up, we have insurance, okay? So they're saying $2,100. That sounds really, really cheap. I pay on my house in Atlanta $1,800 and it's not as expensive as this. So I don't know that I'm going to believe that because you got to have liability insurance, you got to have property insurance. You know, it's going to cost more than that. My guess is it's probably going to be $300 a month or maybe $3,600. And that's just what my gut tells me. I could pencil in here what they had, and you could go out and you could talk to insurance agents about how much they would estimate property taxes would come in at. But this is coming in around 3% of the value of the property, which I think is not even 3%. Sorry, much lower than that. This is coming in at about 1/3% of the value of the property. 3% of the property would be over $30,000. So again, that's just from my gut telling me how I would go about it. I know that what they're telling me, 2,100, isn't correct. You can use anything in their pro forma, but always try to get and seek advice from an actual insurance agent on what the cost is going to be before you go through and do it. Again, I just have experience, so I just know, but it costs you nothing to call an insurance agent and talk to them about it. So just call somebody up. Next up, they have maintenance and repairs lumped into one here. So maintenance and repairs $7,600. They're penciling $6,000 a year, which is $500 a month. Here's my rule, right? At a minimum, I want to do $100 a month a door between repairs and maintenance. So I'll just plug in one here, and I'm going to do $600 because they have 6 units, right? And that's going to bring me out to $7,200 a year. That's just what I use. You can use less if you want to, but I'm not going to, okay? I know that things cost money in this world. Next up, we have water and sewer at $3,000 a year, which is $250 a month. I think that's probably right on, right? Because most likely all the tenants pay for their own stuff. So $250 a month, they're going to be paying for units as they turn over and have to fix stuff. They don't have any money for landscaping in here, do they? And you see any money for landscaping? I don't. Do they have grass and bushes? They certainly do. So we got to pay money for landscaping. We got to have somebody come through and blow this off. Let's call it $200 a month. I'd really say probably $250 a month, right? All right. Pest control. Why are they not paying for pest control? We need pest control. So I'm going to call it $100 a month. Okay. Next up, accounting. Are they not going to pay for their taxes to be done? I think they will. They're probably going to pay, you know, let's say $600 a year. Okay, $50. Advertising, let's say they don't pay any money in advertising, okay? So we have been pitched the pro forma of $33,838 of expenses, but when I come through and underwrite this, I get $48,652 of expenses. That's why my property stats is so great, because boom, you can just come in here, plug it in, and smell the lies of where they're at. So that is all we have to do in order to analyze a deal. Again, there's a lot of different levers that we pulled in there in order to try to get an accurate analysis, and we're not just trusting the broker because they are a salesperson trying to get us to buy and pay the highest price for this. You have to run your own numbers. This is what running the numbers looks like. Again, if you want a free trial to this, you can analyze unlimited deals for over the course of a year. The coupon code and link is below to sign up for this. So if we want to analyze, okay, how good of a deal is this actually? That's where the pro forma button comes into play. So I'll read this out to you here. Inside of year one, let me zoom in on this. Inside of year one, we could have brought in $104,000, but we lost $5,200 to vacancy. We lost $16,000 to concessions, AKA being under market rent, and we anticipate bringing in $82,756. Then we had $48,000 of operating expenses, which gave us an NOI of $34,104. Now, again, if you've read this book, you know how cap rates work. We used a 6 cap, which gives us our value down here of $568,000, okay? So that's where the value comes from. The value comes from the NOI. Then we had our debt service. This is our mortgage payments. We paid the bank $62,760, and our cash flow was negative $28,656. What that means is we had to pay almost $29,000 just to own this property, and that is no good. That's the definition of a liability, not the definition of an asset. Okay, and you can see as year 2 and year 3 goes on, our concession losses go down, our NOI starts to jump some, which makes our property value go up, and it kind of reduces our cash flow to a less sucky number. I mean, it still sucks for sure. We really never have positive cash flow. And again, our potential gross rent and our operating expenses go up through time just because of inflation, right? So here we can read off our balance sheet. Property value, return of working capital, which is the money we put in. If we were to sell it, we'd get that money back. Plus our selling expenses. This is how much you can pay an agent or a broker. Your mortgage balance, which is how much you owe the bank. You can see that goes down through time. And then prepayment penalty on the loan, which again, commercial loans are going to have prepayment penalties. And then sales proceeds pre-tax. This isn't after you get your investment. This means if you were to sell it, you know, and you sold it based off of what it's actually worth, you would lose another $500,000. And again, you had to put $383,000 into this property, so you're losing a lot of money as time goes on. It's really not here until year 7 that you make any money from the sale. So let me give you guys one quick thing you can look at. This is called cap rate on basis. Some other people call it yield on cost. Essentially what this is your NOI divided by how much your total cost of this deal is. Now, if you just want to quickly glance at if a deal is a good deal or not, you can come down here and you can just say, what is the cap rate on basis? My general rule is anything below a 7 just is not going to work. This is a 2.51. The higher this number is, the better. It means the more NOI, the more cash it produces for how much you paid. right? So we want this number to be really, really high. So what do we have to do in order to get this deal to a level of where we would actually want to buy it, or to a level of where if we didn't have the cash, we could go out to an investor and raise the cash from it? Well, there's pretty much one lever we can pull at this point, and that lever is reducing the purchase price. Because again, there's not this huge upside of a way to reduce expenses. We don't have a bunch of conservative expenses in there or anything like that. And then there's also not this huge opportunity to take the rents from $1,200 to $2,500 because they've already remodeled the property. It's a great looking property. It's a great location. They're only $200 under market rent compared to them. Where's the value add, right? The only way to make this a more attractive investment is to get the purchase price down. So what I could do is I could come in here, and again, we had a 2.51% yield on cost. So if I wanted to double that, I would essentially have to cut my price in half. So we're at 1.3 million. I'm gonna go to $650,000 purchase price right now, cutting that in half, and let's see what happens whenever I come back. So what happened if we come through and we look at that is like my property taxes will automatically change when I update my purchase price. My loan amount, my loan payments, all that will change. So all I had to do is change that one thing. Everything else updates for me. And so if we pay $650 for this deal, we have to put $211,000 in this deal. Our cap rate on basis is 6.56, which is okay. Our cash on cash is 6.82, which is okay. It starts to get in the 15% as we get rid of our concessions. Our IRR is pretty strong at 30+%. And our value in the future does start to go up to the $1 million+ because our property taxes are so low. And so now we have a good NOI and we're actually cash flowing. So 650 is something I'd be interested in this deal. But you may say to yourself, well, like, Hayden, how do I know the exact price to pay? Well, I would say just clarify your goals. If you're a person who wants 15% of cash on cash by year 2, then you can come in here, or you say you want, let's just say you want a 30% IRR by year 5, which is something I like, which we have 31.18 right now. So let me do ourselves a favor and say 35%, or you could say, Hayden, I want a 3 equity multiple, which means tripling your money by year 3. You can come in here, type these parameters in, and you can hit seek answer. And effectively what's gonna happen right now is we could see the current price we're paying for this deal is $650,000, but it's gonna go out and it's gonna get me a price that we should pay in order to hit these goals down to the exact number. So if we want to achieve a 15% cash on cash by year 2, we should pay $572,000. If we want to achieve a 35% IRR by year 5, we want to pay $616,701. If we want to triple our money in 3 years, we should pay $634,731, which are all around the current price. But the bottom line is 1.3 million is just way too much money for this deal, right? So I hope that was helpful for you guys. I hope that you enjoyed the walkthrough of my property stats. If you have any questions about analyzing apartments, using my property stats, whatever it is, do me a favor, drop it below. In the meantime, if you got a business partner, a friend, a family member who wants to invest in apartments, do me a favor, share with them this video, and also do me a favor, subscribe to the channel. I'm making this content for free for you guys. And by the way, if you want to learn not just about apartments, but my specialty, which is self-storage, I have another video just like this showing you how to analyze a storage facility. I'll put that video here on the screen if you guys want to check it out. Otherwise, be great. I love you. I hope that you're going to crush it in real estate investing. That's what I'm here for. Grab a copy of my book for free if you want it. Description in bio. See you in the next video.